Hello and welcome to the Quarterly Context webinar for the first quarter of 2017 for clients and friends of the advisory group and WealthStep. My name is Greg Patterson, and these Quarterly Context webinars are designed to provide high-level perspective regarding the economy, markets, and investor behavior patterns to help both our personal wealth and institutional clients better achieve their goals. We'll try to keep these meetings to about 20 minutes, and we'll circulate a video link afterwards should you like to view it again or pass it on to someone you think might find it helpful. And if you have any questions, please submit them to the question box, and we'll address them either as we go along or at the end of the webinar. As a regular check-in point, we encourage people to focus on their goals, and in particular, in that effort, what matters most and what you can control. That is really the area where you can have the biggest impact, and especially when people are nervous about markets or nervous about politics, that can be a helpful place to focus, for that matter, beyond politics and markets as well. In terms of markets recently, very strong first quarter with the U.S. market up almost 6%, international markets up almost 7%, emerging markets stocks up over 11%, and real estate at a relatively moderate 1.4%, with the U.S. bond market up 0.8% and international non-U.S. stocks down about 1/3%. The relatively strong returns of international and emerging market stocks are a good reminder of how an asset class that is out of favor tends to eventually revert to the mean and return back to favor. So the U.S. and international stocks will take turns over time, as will value and growth and large cap and small cap, and the same happens over time in the bond markets. It's interesting over the long run, since 2001, for example, that the average quarterly return has been what's shown here, between the 1.5% to 3% range, and that highlights how particularly strong this recent quarter was. And some of that strength came off of election factors abroad, in domestic comments from the current administration in Washington about taxes and infrastructure spending and other elements, but there's also been some volatility around those elements more recently, with concerns about the degree to which some of those growth-inspiring or growth-catalyzing policies are really realistic or possible given funding and political factors. Somewhat along those lines, it's always interesting to see there's always short-term news that tends to move the market a little bit, whether it's local or foreign politics or economic data and so forth, or the Fed raising rates or deciding not to raise rates. And it's important to keep perspective, because in the long run that all smooths out over time. In terms of economic highlights, the gross domestic product, or the growth rate, shows a little bit of a slowdown. Inflation remained fairly flat relative to recent numbers, at solid but not yet weakening rate of around 2.1%. The Fed is struggling as to what to do with rates in light of expectations of some growth, but also wanting to control future inflation while minimize the chance of deflation. Unemployment fell a little bit, and the two highlights really were that wage growth continued to improve, and is sometimes a precursor of a little bit of economic strength and inflation, which is why some inflation assets had some relative strength. And the consumer continues to be relatively confident, as we'll see in a chart in a moment, hitting a relative high over the last 17 years or so. Taking a peek at the last, where we are in this market relative to other major market crashes and recoveries. Seems like a long time ago in many ways that the global financial crisis occurred, but we can see here as well the Great Depression market, the dot-com crash and recovery in green, and the 70s oil and financial crisis of the 70s. And this larger chart is on an inflation-adjusted basis, so we can see that the current market has been relatively stronger recovery versus the other markets. And if we see in this smaller chart without adjusting for inflation, the most similar market has been the oil and financial crisis of the 70s. But this blue line is not too far off the long-term average now that there's been a recovery from the crash, with the last 5 years annualizing about 15% for the S&P, just as 1 point marker. And those are certainly higher returns than long-term averages and higher returns than what are expected, as we discussed in the last quarterly context where we reviewed the updated capital market expectations. This is a chart that should look familiar. We've presented it a few times in different ways in the last couple of quarters. The chart that shows that political parties tend not to be a particularly good predictor of market outcomes, tend to be fairly neutral in that regard. And this chart now showing the Fed interest rate changes over time relative to the US stock market as represented by the S&P. In this case, we're using a logarithmic line, which tends to be less dramatic and shows better represents the changes of movements in markets versus the cumulative line that we showed last quarter. So here you can see as the interest rates rise, there tends to be a corresponding pullback in the markets for a little bit. So rising rates, markets cool a little bit. Market rates drop, the market tends to pick up. More recently, in recent years, the trending downward, and market and rates have and the market has responded positively. Now we're in a cycle potentially and eventually where rates will be rising. So the degree to which the stock market responds will depend on how quickly those rates move, which has been relatively slow, and the degree or magnitude of the changes, which are expected to be relatively small or incremental. But you can expect some volatility down the road as that occurs. In terms of other economic details, just point out that, as I mentioned a moment ago, the inflation, the unemployment line has cooled down. This also relates to the labor participation rate dynamics as people stop looking for jobs that can artificially improve unemployment numbers, but over time that tends to average out. So essentially at around 4.5 to 4.7% unemployment, that's considered full employment, and we've been hovering around that number for a few quarters. Here's the consumer sentiment pattern in more detail. You can see how it's now hovering up around a high that goes back to more than a decade ago. Oil is at a relative low versus longer time periods, but has been on a little bit of a rise more recently. In terms of market valuations, that may give us some sense about what's to come in terms of volatility. You can see the S&P is at near a relative high over the last 10 years. Other markets, US and some foreign markets, are towards their 10-year highs, with emerging markets and a few other asset classes, the Asia Pacific and energy, not near those 10-year highs. So usually when markets are floating up towards the top, that may mean there could be a little bit of extra volatility on the horizon. That doesn't necessarily mean a market crash, of course, but that just may mean as part of the cycle, there tends to be more volatility. That's something we've been discussing for a while. In terms of the dollar, you can see here a longer-term chart going back to 1970. Since the cycle back and forth versus a basket of international non-US currencies. And over recent years, there's been a relative rise in currency with some weakening more recently, and that's helped international holdings within the diversified portfolio. Our most recent creation in terms of a periodic table of returns is shown here. In this case, we're showing only diversified portfolios as represented by 10% increment of stock bond mixes, and using the a global stock and global bond index as the components. So what you can see here is sort of by definition, a middle mix will hover towards the middle, 60-40 mix, and the high stock and high bond portfolios will tend to be at the top and the bottom, because when there's strong stock markets, they'll float to the top, and when there's weak stock markets, the heavier bond exposure of a 20/80 portfolio, for example, will then float to the top as with extra cushion from bonds, and then everything else tends to hover around that middle point with the different asset allocations. So it's basically a message is you will get what you ask for based on your asset allocation, and in the long run, stocks tend to outperform, but you have to be willing to tolerate certain periods of weakness. And if you're in a period where you're spending or don't require so much volatility related risk in order to achieve higher growth numbers for your plans, then lower stock allocations can minimize that volatility. In terms of the quality thermometer, a lot more red and pink versus the last couple of quarters. During the post-global financial crisis several-year market run-up, it looked a lot like this as well, where lower quality stocks tend to outperform that are more speculative. So the red indicates where low quality outperformed, and the numbers inside the boxes show whether the quality, the percentage difference between high quality and low quality. So a negative return number here, for example, would show that lower quality stocks outperformed, or conversely, that higher quality stocks underperform by that amount relative to the low quality stocks. So a lot of red here. That doesn't necessarily mean all negative returns. In this case, it happens to be, but that doesn't mean negative returns on an absolute basis, just on a relative basis. So markets tend to cycle back and forth in terms of quality, and when and if volatility picks up, higher quality exposure tends to minimize volatility a bit. In terms of bonds, after an interesting year last year where we had 7 consecutive positive bond month returns followed by 4 negative and then 1 positive, so far it's been a little more mixed. With following the fourth quarter 2016 Fed rise, markets have been a little bit more boring, shall we say, a little more stable. However, bond returns have picked up a little bit more recently in the second quarter, as there's been a little bit of an increase in stock market volatility. In terms of investor behavior patterns, showing the mutual fund industry cash flows over the years. Not a whole lot to talk about here, except that the biggest chunk of flows went into taxable bonds. Not a lot of negative flows except out of liquidity or cash. So it may be that investors who have been tired of having 0% return in money market accounts have pushed money into bonds as well as stocks, but more so into bonds at a time that may be in advance of some more bond volatility. So in general, this rear view mirror driving tends to damage results due to these investor behavior factors. In terms of a review of one of the many areas where we help clients have value added to their outcomes, oftentimes it's hidden value added, a number of things we do in the background, so we'll periodically be reminding you of those factors so that you are familiar. One is rebalancing. Most clients experienced rebalancing in the last couple of months as markets have been at a relative high. That led to some stock holdings outweighing the asset allocations and the parameters that we establish for rebalancing. And so that trimming of what has been outperforming helps reduce risk in the future and has already minimized a bit of risk as the volatility picked up subsequently after that. So rebalancing shown here in this chart tends to reduce a portfolio that's buy and hold without rebalancing over time will increase the stock exposure and change the risk profile as represented here by standard deviation. However, what's interesting is that when regular rebalancing, if a portfolio, for example, were 60-40 and it were to stay there, here's where it might end up over a number of years. But you maintain lower standard deviation, but actually increase your return because of that. There's an element of systematically buying low and selling high as you trim the portfolio and maintain in the process of maintaining the risk profile. So there's a bit of a free lunch in that process. In terms of rules and regulations, won't go into too much detail here. Maybe one of the biggest news items is that the administration in Washington has put a hold on the fiduciary rule. It's still yet to be determined as to when that will be implemented or if that will be implemented or to what degree it will be changed. So that puts a pause there. That applies to both retirement accounts in terms of IRAs for individuals as well as retirement plans that fall under ERISA, for example. Another item of note, California's Secured Choice Program is also stalling because of challenges from Washington about whether or not a state has the authority to implement such a program. A couple of details here about what that would look like if it were to be implemented, and of course that could change, and that's all up in the air now. A few other items here, won't go into too much detail. Just say that a few regulations have changed regarding forfeited balances, and now the IRS has the first ever pre-approved plan documents for 403B plans. With that, I want to remind everyone that our focus is on helping you meet the 5 requirements for financial success: the resources, knowledge, time, desire, and discipline that make the difference to help you get from point A to point B. If any one of those elements is missing at any given point in time, that can hurt the results. And our process and what we do to support you is really focused on helping you fulfill all 5 of those elements to improve the achievement of your goals. We also very much value your thoughts and are always interested in hearing whether you feel well supported and how we can support you better. And at any point in time, please send us a note or call us answering this question if we haven't asked you face-to-face recently. What's the one thing that we could do better to serve you that helps us? We want to hear your thoughts. We want to listen to your needs, of course, and we want to continuously improve what we do for you. And if you have others that you know, whether they're institutional or personal, where that you think are a fit and could receive the same type of help in the ways we've been helpful to you, of course, we always welcome those introductions. And look forward to speaking with you soon. And we appreciate you viewing this webinar. Have a good day.